That was Deborah there giving us some of the realities to the numbers that it seems sometimes those numbers do not just add up or they don't mean anything. Well, it certainly means something. Inflation at over 31% means that bag is not even up to half full anymore. Thank you so much, Deborah, for all of that. Well, now let's go to another matter which started last week. That's the recapitalization of banks. And yes, we've been talking about it since Friday, but the banks have 2 years, 24 months to catch up and meet up with the requirement. Now let's get the perspective of the Association of Senior Staff of Banks, Insurance and Financial Institutions, ASSBIFI. We have their president joining us virtually now. We have Mr. Olusoji Oluwole joins us virtually, even he's from Lagos. I know the holidays would not allow you to join us physically, Mr. Olusoji, but thank you so much for your time and happy Easter.
Happy Easter to you, Rini, and to all our viewers.
So this shouldn't come as a surprise because the central bank governor has given us hints on this many months ago. But what is the perspective of ASSBIFI on this? I mean, you guys are your members are directly affected by this.
Yeah, thank you very much. Just like you said, it didn't come to us as a surprise. He had hinted it when he spoke about the having a strong banking sector in a $1 trillion economy like ours in Nigeria, which is what the government is expecting to happen. So since he made that pronouncement, it's something that I know that our institutions had started preparing for. So the information coming didn't come as a surprise to us, setting out the plans. Now for us as ASSBIFI, we are very much aware of what has happened in the past during such recapitalizations, the last being in 2005, when banks were expected to move on from 2 billion to 25 billion naira. We know that some banks were able to pull it through themselves, some had to go through mergers, some through acquisitions, and it had its attendant impact on employment of workers. And because of that experience now, we also had proactively acted by informing the CBN and the Ministry of Labour, as well as our labour centres, of the likely impact on our members, because when these kind of things happen, we know that there are some cases where, due to duplication or excess manpower, there are job losses. And we expect that there will be a lot of fairness in the actions that will be taken, and to ensure that our members are well protected, and where they are affected, they are well compensated.
Yeah, because I was going to ask you about how true the fear or threat of job losses, saying that, I mean, we're expected to see mergers, acquisition, upgrade of banks, even though there's also the expectation of downgrade. But how fierce is that fear of job loss in the financial institutions?
Well, you know, this is something that is just unfolding. So whatever we say now will be based on what we have heard now. So our perspective will change in future. Now, if we look at it in 2005, there were almost 100 banks. Today, we have barely 24, 25 banks in Nigeria. And when we look at the raising of capital at that time compared with now, it's a totally different thing. At that time, I cannot say that the interest in stocks was as intense as it is today. Now, if we're talking about acquisitions, we have 24, 25 banks. How many are actually going to acquire? That's one. Two, we have banks that are in different areas of the economy, different areas of businesses, just like we'll find in the CBN circular. We have banks that have international licenses, those with national licenses, and those with regional licenses. They run totally different businesses, so to speak. So it's not going to be the way it was at that time. Now, given the 2-year timeline to achieve this, there is actually that probability that banks may just be able to pull it off and raise the minimum capital that is required, or in another breath, they could come together with measures that will actually make them bigger and not have the kind of impact on the on staff that we had in 2005.
I hear some news that 11 banks are actually, threatened. How many banks do you see surviving this when you look at the sizes? I believe the tier 1 banks, I think, could easily scale through, but maybe the tier 2 and all of that. How many banks do you see making it through out of the 25 presently in existence?
Well, it's not something that I can really make a pronouncement on or speak on right now, because like I said, the moment the CBN governor made that pronouncement, a lot of banks had started making moves to start increasing their capital. Now, mind you, bear in mind that banks today are not do not have a capital base of just 25 billion. Over the years, they have increased it to various amounts. Now, if we're talking about the tier 1 and the tier 2 banks, remember also that in the tier 1 banks, we have those who have international licenses. So you will probably find out that what the international banks may have to raise is way above what the national banks have to raise. And like I said earlier on, the interest in stocks in 2005 is totally different from now. People are more enlightened, people are more interested. We've seen some kind of stability in the Naira in the last 1 or 2 weeks now, which means that there are also foreign investors who may be involved. So for all you know, banks may actually end up being oversubscribed at the end of the exercise, but that does not eliminate the fact that those mergers could occur. So I think in the next couple of weeks or months, we'll begin to see where they are and begin to see the plans that will be rolled out, just like the CBN has directed, that they want to know what the plans are. So and we're at a time when banks, banks have uniform financial year ends. So about this time now, we're going to begin to see the reports of last year, and we'll begin to see what it is actually that is in place. Then we'll be able to talk about the possibility of being able to raise the kind of money that is required by June. I think it should be June 2026.
Yeah, Mr. Oluwole, just before we let you go, and briefly now, so all of this is to make a bank stronger and be able to, lend more to the real sector. But I mean, I kind of have to remind myself that more liquidity in the banks does not automatically mean more funding to the real sector. We have CRR, we have NPR, all of those are on the one hand. And then we also have the issue of banks maybe not trusting some of those sectors enough. How can we translate more liquidity in the banking sector to more funding to the real sector?
Well, banks are in the business of lending. That's their primary purpose. So banks not wanting to lend, I don't think that is going to happen. And remember that banks are expected to give out a certain percentage of their liquidity as loans, failing which the balance will be sterilized by the CBN at no interest. So it is not in the interest of any bank to want to hold on. Now, when we talk in terms of trusting the various sectors, now that is where a lot of regulation is going to come in. We find ourselves in a situation where a simple regulation or a simple legislation could actually put a lot of these credits at risk in the banking sector. I'll give a simple example. Recently, Lagos State passed a law on styrofoam packs. Now, imagine if a bank had invested heavily or given a heavy credit to an organization that was just about to set up a plan somewhere in Lagos, factories had been built and everything. It simply means that there is going to be a problem. So that is the kind of challenges that that are usually faced by some of the challenges that are usually faced by the financial institutions. So yes, they are very ready to lend, but of course they have to ensure that the funds they give out are well utilized and are secure. Especially when thinking of the depositors and the capital that they are giving out.
Okay, thank you so much, Mr. Olusoji Oluwole. He is the president of Association of Senior Staff of Banks, Insurance, and Financial Institutions. Thank you, and happy Easter once again.
Thank you.